Alrighty, welcome in, guys. Good morning, good evening. This is the start of a week in which we are probably going to see a little bit of a change in tune for the market. And in other words, you're gonna hear Jay Powell say,
"Fuck your puts, fuck your calls. Jay Powell has you by the balls."
and so having said that, let's have a look at the macro from this week. There is quite a fair bit to discuss because this week is going to be very macro driven. Just kind of giving you guys the updates from last night, which you might have discussed with Andrew on a more granular basis. But hedge funds rotated into U.S. defensive sectors ahead with healthcare stocks and other specific pockets of the market ahead of the Fed meeting. And then I was discussing with two other students on mentorship this past week about the uncertainty in oil prices because of OPEC plus, little developments in terms of production and whatnot. So there are definitely some important things to note here. Now, remember, there are times in which hedge funds make rotations that do make sense, and then there are times that hedge funds make rotations that are completely bizarre and I never follow them, right? But actually today, what I'm looking at in terms of what they are rotating into does make sense because healthcare, one of them, is a defensive sector. When prices, stock market prices start to come down, people usually rotate into healthcare and consumer staples and utilities as a defensive play for protecting their capital when the market's in a downturn. So I do kind of agree with this rotation, and there is obviously a few reasons why I'm saying that. But the move on staples is mainly over already. Okay, so there is, in my opinion, there's no good risk to reward ratio here. Okay, and if you look at utilities, the same thing, sitting on a very key pivot point. And if you look at healthcare is probably the only one that has like potentially decent upside, a lot of ground to recover. So out of the three sectors, it's only healthcare that I would be interested in out of all three. I wouldn't want to be going long in the others just before anything is reported by Powell this week. Okay, and I'm going to get into what Powell's about to do in a second here, though all of you should already be knowing what he's about to do because we've been talking about this for weeks on end. Okay, now in other news, crude oil prices have fallen to 3-year lows. Managers net sold global energy for 6 weeks straight. So oil and gas sector has been hit very hard. I'm not sure if you guys have been following this, but if you look at your XLE, XOP, right? XLE back actually when just this trade war tariff thing happened, back to a very important demand zone, which was down here, right? And even swept liquidity, right here. You can see that was your support. It swept liquidity before pulling back up. Now, having said that, there are quite a few constraints at play here, and OPEC Plus has now this morning put out a note saying that they're going to continue to hike supply, which then causes additional issues for oil prices, right? Because I'm guessing one party doesn't feel it's fair, another party feels it's fair, so they're collectively deciding to hike. Now, I've mentioned this many times before, Russia still remains the world leader in terms of margin for production of oil and gas. Okay, they produce at the cheapest margins. Okay, that might have changed a little bit when America discovered fracking. I'm not sure if you guys are aware, but now that development has taken place, and remember that Russia has been kind of sanctioned out of this market, so to speak, they have been using other ways to sell their oil to the world, which involves reselling and repurposing oil from through trade routes in China and India, which are part of the BRICS nations, right? So they're kind of getting their exposure there somehow. So if you add a already cheap Russian oil to a very cheap Russian crude oil market, which if you look at XOP, here, here, right? You will see that I think majority of the bad news has been likely priced in at this point already, okay? So now, I obviously wouldn't want to play oil and gas here to the upside just yet, because I want to also see what happens with interest rates. And remember, another thing is that the dollar has fallen pretty far down, and majority of crude is traded in dollars, right? So it's actually more cost effective to trade crude when dollar is low, which means it lowers the margin pressures on a variety of different things, okay? Now, why am I mentioning this? Well, crude being low and the dollar being low is a very inflationary environment for equities that are sensitive to crude. For example, if you have a industrial stock like Boeing, for example, it will tend to have better tailwinds in the next 3 to 4 months and see margin pressures decompress. Another company that might benefit would be Caterpillar, for example, right? Big pieces of machinery requiring crude, many different types of byproducts within crude. And Lockheed Martin as well, for example, right? So if you have big industrials, especially the oil producers and oil manufacturers or oil users, that includes your, travel stocks, that includes a majority of the other businesses. These businesses might see temporary margin relief, which might help their bottom line a little bit. Okay, so that's just one small piece of the puzzle that I wanted to kind of bring to your attention with relation to crude. Okay, but remember, it's one of those things where you kind of have to think of what happens from A to B to B to C to B to C to D, and so on and so forth. Okay, let's have a look at Prime Book from this week and kind of figure out what's going on there. 3 weeks of net buying. Hedge funds modestly sold U.S. equities this week. So they're kind of ahead of the curve here. Of course, we had decent earnings coming out from mega cap. Apple's earnings wasn't that bad. Okay, now I know the market reacted very unfavorably for Apple, and yes, I have already mentioned this a couple weeks back that Apple will be overtaken by NVDA in terms of market cap in the next couple of years, right? Or even this year, maybe, we don't know. But if they fail to innovate and fail to, put out products that are really going to push the envelope, then what's going to happen is they will just slowly fade away, just like how every S&P 500 company does. So it's nothing special here, okay? But as we are seeing, you had single stocks collectively net sold for a third week, okay? Hedge funds rotating into defensive, as I just mentioned, healthcare, utilities, staples combined. Saw largest notional buying in the past 3 months, as all sectors were net bought for this week, driven entirely by long buys. Why are they doing this? Ahead of a FOMC and ahead of a expected pullback on the S&P 500, okay? And then, crude below that. Okay, so that was just from this one. Now, the net flow, right? This is from the Prime Book net flow. So remember how the past couple of weeks we had a lot of that net flow on the bottom, right? And remember this chart, the black bars are the past 20 days and the blue bars are the past 5 days. So if you look at just the past 5 days, you can see that healthcare, utilities, and staples, they were 3 of the sectors that were net bought, the most net bought. And in the past 20 days, you have all US equities, you have macro products, you have financials that have been bought, right? And a little bit of real estate as well, okay? Hardcore selling in the past 20 days of staples, but then now the past 1 week, net bought on staples for the past 5 days. Do I like the chart? I don't, right? So I'm going to ignore this data point because I don't really like the setup. It doesn't match my risk profile. It doesn't match my, in terms of any setups that I want to take. But there may be pockets within staples that might be good. I will have to look at it, right? Okay. This is just your net flows. Nothing really that interesting. Okay. And then you have tactical sentiment, right? Remember just 2-3 weeks ago, we were here. Now we are here, right? And that means that we are probably going to go back down at some point. It doesn't have to be today, but at some point, right? It's a tactical sentiment just telling you where tactically the risk to reward ratio makes sense. And so a lot of people are overcrowded on the buy side. then now we expect the market to kind of reverse and go into the sell side a little bit, right? So just keep that in mind. Okay, then the other important thing here that I was going to cover was sector rotations. So let's kind of get through that. S&P 500 implied move through this week is 2.25%. Lower dose of earnings next week. Now, there was one piece of data that I wanted to show y'all, and it was aligning with what I mentioned yesterday, not yesterday, last week. Let me try to find it here. So before, if you guys realize, the past couple of weeks, the S&P 500 has been moving pretty crazy because the VIX was high, right? The VIX was high in this past couple of weeks, for all the way from April 1st, and now coming to May 1st, the VIX was elevated until, I want to say, April 15th even. Now is where we're coming out of the elevation. And this caused the moves on SPX to be more exaggerated, right? That's the reason why you guys saw such big volatility, right? Big moves, up, down, up, right? So now that's going to change because the options market is starting to focus on the fact that the market daily implied move is going to start to become more flat over the next several weeks, which means we're going to go back to some form of normalcy. Okay, you can see FOMC day, the implied move is about 1.1%. CPI day, which is on 12th May, is 1.2%. ISM next week, 1.1%. Payrolls, 1.3. CPI, again, 1.1. That's June, right? We have a FOMC meeting coming up on Wednesday. And so let's talk about that next. Now, there is absolutely no doubt in my mind that Powell is going to be, having a rate pause decision. If he rate cuts, it's going to be obviously a very big surprise, right? And the main thing to understand here, oh, wait, why didn't this pull up? Oh, that's weird. Let's see if I can pull it up on the side. If you look at the rate decisions, okay, I guess right now it's not pulling it up, but I pretty frequently pull this up, right? If you look at the last one that I pulled up, it was right here. This was just last week, right? You can see that the chance for a May rate cut is definitely not on the table. For a June rate cut, the market's now priced in a 56% chance. As of this morning, you can see that the bond market's kind of still stabilizing in this move. And the broader move down, right, is still intact, okay? Still intact, because remember, you have to zoom out on this chart to a weekly to understand what is going on here. If you look at the weekly chart, you will start to understand the picture here, right? So this is the bond, the 10-year yield has been in a very big uptrend since 2020, right? And now it's starting to find a little bit of a distributive channel, which does not need to mean that we're going to come down, okay? It doesn't mean that. What we are just tracking here is to see whether we revisit lows and how well we are respecting this long-term 3.17%, which is a key level on the 10-year, okay? But remember that if the 10-year yield goes further down, that means that people are buying bonds, right? And if the 10-year yield goes further up, means people are selling bonds. And in this case, it's kind of staying still here, but the June meeting is likely going to be a rate cut, and the July meeting is undecided right now, okay? As the market prices in, more data comes out, more information about tariffs come out, then you'll be able to see whether the market's actually going to move towards a rate cut or it's going to start pricing in rate pause. But one thing that is very, very certain is that that Powell is likely going to say something like, the economy is doing really well, there is no reason for us to step in and do a rate cut. There is, if need be, the Fed will defend, something like that. It will be a very mixed statement where, and that will come out in the press conference. So please do not react when the rate decision comes out, as usual. For new people on here, if you have never been a part of a FOMC week, it's the same piece of advice I give you all every single time. Don't trade until after FOMC, which is post Wednesday, which means more than likely Thursday, Friday. Market will be very, very finicky. It will be trading very flat and not really give you a move that you want. And very likely a lot of people speculating on either side will cause the market to be uncertain. Okay. So having said all that, let's have a look at the sector rotation heat map. Mega caps currently kind of seeking this renewed bottom, which would then become a support, right? So momentum is definitely pointing down. Financials momentum is pointing down. Energy is looking like we're entering dip buying territory, right? Consumer cyclicals moving down, but not there yet. Industrials, we are now there, but we can go further down, as you can see in the past, right? And then if you look at materials, we are there. Good dip buying opportunity. Consumer staples, you can see why I don't like this setup, because if you can see it here, consumer staples is one of those that are in between the momentum move, and healthcare is the other setup that I really do like, as I was mentioning earlier, right? It's dipped down into its bottom percentile of the standard deviation move. Real estate approaching there. For those of you that have been looking to get into REITs and stuff, this next dip here will probably give you that opportunity, right? And once again, utilities, I don't like the setup, as I mentioned, because we're right smack in the middle of the momentum indicator. Small caps approaching that bottom band where it will become attractive, which if you guys still haven't added to IWM, I don't know what to tell you. And then, yeah, that's the main ones. Okay. So as you can see, there are two charts that I look at. One is a momentum based chart where it's sector positioning based on standard deviation. It's z-scores, right? Weighted average z-score across different indicators. And then the other one is the prime book report, which is where I can see actually where the money is moving, right? So that gives me a little bit of better picture on where money is flowing into different sectors. And then once I kind of figure that out and where the advantage is, it's where I can start looking at individual within these sectors. For example, if I know that let's say healthcare is in the buying kind of area, right? Then what my next job is to go look at the top holdings, right? Top holdings in XLV, for example, right? Because that's your healthcare sector, and then you would know that your top holdings for XLV are Eli Lilly, are UNH, are Johnson & Johnson, are AbbVie. Now I would look into all of these individually, right? LLY, for example, not that great of a setup, right? Right off the bat. UNH, decent setup, but is bleeding, so you don't want to catch a falling knife, right? But also approaching major support. And then you have ABBV, for example, right? Being bought up after a dip, okay, looks decent. If it can break and hold this level, maybe there's upside, right? So, okay, there's a potential setup here. So that's how you should be using the data and kind of making your own decisions. Instead of kind of using just pure technicals, you have to have this approach where you're mixing both of the disciplines together. Okay. So having said that, that covers most of the macro. Fed will pause rates. Fed will remain hawkish. Fed will likely say that they're willing to support the market in no matter which way it takes, which is a little bit of a dovish slant. For those of you that are not aware what hawkish is and dovish is, dovish means that the Fed is peaceful. Hawkish means Jerome Powell wants to fuck shit up. And he wants to remind you that
fuck your puts, fuck your calls. Jay Powell has you by the balls.
Okay. Now, having said that, let's go into the technicals. So SPX. Now, we spoke about this last week. Andrew had the plan perfectly down. We were talking about the fact that we could continue to melt up. And on top of that, we have been moving very nicely in this tight range with very little regard to what the fuck bears think, right? The market's been firmly melting up and pushing price up, though bears have been trying to push the price down, right? And now we are approaching this very important zone, which is your potential rejection zone. If you look at based on this wave from the bottom, right? If you look at this fib is based on this wave all the way down to this wave, right? So we're taking this big wave that was previously bought from in terms of momentum, right? your 23.6 and 38.2 extensions, which forms part of your golden pocket, is literally here, right? And so as Andrew says, and as I usually remind you guys, whenever you're entering this range, this area is your validation and a no trade zone most of the time, right? Because you could reject in here very easily, and also at the same time, you could break out of here very easily. So let's talk about what the plan should be for this week in terms of the nitty-gritty from my perspective. From my perspective, because the CTAs, as I've been talking about, the Commitment for Commodity Traders Association, have run out of ammo to sell anymore. And at the same time, we're seeing momentum reverse here. There was a report that I was highlighting from last week, reminding you guys that a lot of people did not buy this dip because they fell prey to news, they fell prey to the headlines, they fell prey to panic and fear and anxiety. Not many people bought this dip, okay? And if you were a purchasing manager or a portfolio manager or something like that, and you didn't buy this dip, then you need to artificially create another dip in order for you to do so. Okay, now, not am I saying that the market's going to do that, but it is a very highly likely scenario because with FOMC comes uncertainty. With uncertainty comes a market throwing another fit. And as we approach the 38.2 and 23.6, this does look like the likely scenario for this week, even if the dealer data might not make sense, because it takes one move or one word from Powell to set things off and give us a corrective wave down. So where are those corrective waves levels? Let's talk about those because those are important. Okay, so from my perspective, we could still melt up into 57.65, which is the 38.2, right, before ultimately pulling back. Okay, and my first level of support should be in this dual zone, which is between 54.40 to 5500, roughly. Okay, that would be my first level of demand that comes in for dip buying, which would also align with this trend line, which has been here, right? And then that would give you like a kind of reversal play up into the 61.8 at 59.28. Okay, that's one scenario. Another scenario, if shit really breaks down at the same time, Trump decides to say some BS out of his ass, then what's going to happen is we might go further down into the 53.40, which is your next level support right here. Okay, and if it gets really, really bad, then you might get all the way back down into 50. Let's just call it 5,077 all the way to 5,158. That's your next level of support. Okay, the 38.2 here will also be a support, but I think it'll be less of a main local support. And if we do get that kind of a sell, which will be a bit of a panic sell, because this would be a pretty substantial move, right? If you were to move from here all the way to here, you're looking at a 10% correction once again, right? I doubt that will happen, but maybe a pull back into one of the demand areas, highly possible. Okay, now that's your three downside scenarios, which means that putting on a hedge in this area does make sense. So for those of you that have not hedged your portfolio, this is a good time to hedge. Just mind the fact that puts may be overbought. Remember not to pick contracts that have super high IV. Your acceptable range for IV should be between 30% to a maximum of 40 to 50%. I would not go beyond 50%. 50% means it's already like, it's really expensive already, right? Medium, this is medium. Obviously, super expensive is like 100 plus IV, right? 100 plus percent IV. But we don't even look at these. This is like beyond the territory that you would trade in. If you're buying 100% contract IVs, you deserve to lose that money, right? Like you're an idiot. 30, 40 is still like within the acceptable range. So make sure you're looking at contracts within that range. If it's less than 30, even better, right? It means it's not so saturated, you have liquidity. Make sure you're looking at the open interest of the puts. Make sure you're looking at the volume traded, all those good pieces of information before you take a trade. I don't know if you guys are doing this, or are you just like putting your finger in the sky, touching your I don't know, your palms and hoping and praying that things go your way without looking at that information, looking at the options chain, making an informed decision. Okay, so the three bearish outcomes, done. Now, what about the bullish plan, right? The bullish plan is if we get above 57.65. And let me tell you that if we do, let's say the market does this, you're going to get a massive, massive squeeze. Because a lot of people are going to be hedging up here. This is going to be the natural hedging position. And so that does, it does kind of make a case to say that there will be kind of a self-fulfilling prophecy. Because remember that if there is a skew on puts, for example, there are more people buying puts, then there will be incentivized action from the market maker. Eventually, when prices do fall, right, the market maker will be incentivized to hedge by selling shares because his gamma would be negative, right? So because more people will buy puts, that might lead to the prices falling, and that's what we call a self-fulfilling prophecy. But that's only if prices fall. But if prices rise for some reason and put exposure is still high, what do you think is going to happen? People are going to reverse out of those puts at a key breakpoint, right? Which is going to be 57.65, or this area right here, right? If we break this, and then the market's going to start chasing upside momentum, and that will be a melt up. That will be some kind of a move in which you will see the market will get up to the 61.8 extension very quickly. Okay, so those are your two scenarios. Now, for upside, you have to clear 57.97, which on SPY is around 5. Wait, hold on. It's 575, 576, right around there. Okay, and then your target will be 588. Okay, so let me do it on SPY since most of you use SPY, so that you guys don't start freaking out, because I know how you guys be sometimes. Okay, so this now will become your support, right? This is a dual zone, and then you'll have another level down here. Okay, so quite a week ahead, and that's from the technical perspective where I am on SPX. Okay, please do not take stupid trades. I try to remind you all every single week that you should be taking setups that are really, really strong instead of wasting your time on setups that are not that great. For example, taking a put position up here as a hedge means that you're not going to assign $1 billion from your portfolio into there. You're going to assign like a small percentage of your portfolio into there. What does that mean? Between 5, like for smaller accounts, you should be doing 5 to 10%. If you're a bigger account, that means you're doing like 2 to 5%. Okay. Like if you're above $250,000 account, your hedge amount should be around 2 to 5%. But if you're a smaller account, you're going to have to put on more percentage of your portfolio because hedges are going to be more expensive. So likely the higher end of this is 10%, and that should be the maximum you sink into your hedge. Now, what about in terms of timeline? How do you select the hedge? How do you, go ahead and choose the contract, all that? Let me just kind of cover it within 1 minute. Hopefully my Webull opens here. Okay, there we go. Right? Let's have a look at it together. Okay, so if we're looking at SPY. Now, first things first, you want to choose an expiry that's going to be kind of post FOMC, but then also some more time. So for the first one we'll look at is 16 May, because we want more than enough of time for the play to play out, right? And then what about the strike price, right? So a lot of you, when you're choosing hedges, you just go gung-ho, and then what do? You just go like, oh yeah, you know what? SPY is going to drop to like 525. So I'm just going to pick a super out the money contract. And then if SPY moves to 540, I would have made like 500%, right? No, that's not how this works, right? But I know the way you guys think, and you know how I know that is because I have thought like you before, right? So over the years, you'll start to realize that prioritizing contracts that are nearer to the money is always better than prioritizing contracts that are out the money, which are unlikely to hit. Okay, so prioritize the ones that are closer to the money, which means the most likely strike for you to hit, because your aim is not to be a pure gamma trade, right? When I'm talking about a pure gamma trade, means that as the trade gets towards the money, gamma is going to be at peak. We don't want a pure gamma trade where you have to get to all the way down here to be at peak gamma. Your peak gamma should be very comfortably within your range of target, which then feeds into a delta driven trade, because then delta takes over in terms of money making. For those of you who have no idea what I'm talking about, this is all a part of the options course, which is completely free for you to view. Okay, so you haven't done the homework, that's on you. Okay, that's on you. So now, having said that, 545 or 548, 550 even are great strikes to go for. So if we were to look at this, right, 550 or 545 would be my choices. So 545 is currently trading at around $2.70. Okay, it'll be a bit different when the market opens. 550 is currently trading at $3 or at 350. So maybe market opens to be 370 or something like that, right? So these are the two contracts. If you're really feeling like, oh, it's really going to drop aggressively, 545. But remember that it might not get to the strike. So you have to be ready to take profits or move your contracts into profits. 550, more likely to get in the money, right? This would be the one that I would go for. Okay, next week expiry, 550, that's a hedge-like position. Now, also remember that the open interest on these are superior to most of the other contracts, right? But let's look at the implied volatility, 23%. Does that fall within our category? Does that fall within our acceptability? Yes, it does, right? What about the delta? Delta is at 0.2, 0.27 for this one. I like this one far better, right? So this contract would be the one that I would go for. This one has a slightly higher IV2, right? 46,000 open interest on this one, 43,000 open interest on this one. Alternatively, you can also go for the 546, by the way. It has 12,000 open interest, right? So those three would be the ones that I would typically choose, okay? Now, that's all I have. I think I covered everything. I think I went over everything that I needed to. Sorry, it took a while. It took a while only because I wasn't, present for the weekly prep session, so I decided to do it all here. But I covered every damn thing that you need to know for this week. Now I'm handing it over to Andrew. Thank you all.
Right. I agree with pretty much everything he talked about. As I talked about last night, right, most likely Monday and Tuesday are going to be pretty slow. Same concept as last week, right? Remember last week I said, if you were an investor and you had $100 million, would you be putting your money at risk or pulling your money out of the market prior to those mega cap earnings? Probably not, right? Because you wanted to hear kind of what they had to say. And it's going to be the same thing this week, right? If I have $100 million and I'm looking to put it at risk, am I going to put it at risk before FOMC? No, because essentially I'm gambling at that point, right? I don't know how the market's going to react. So I'd rather wait, see what the market does. And once I can identify that direction, then I put that money at risk, right? So just a few things I'm going to go over. First one being where we're currently at. So 15-minute time frame. Here's your pre-market price action. So pretty easy evaluation. You're just going to put this in a box. There's your day trade. Okay, so for all the people that want to day trade and get really excited over $1 to $2 moves, this is what you're looking at. A break over the high would be a gap fill, maybe up into the high. A break into the low would most likely come down into 560. We talked about if it breaks 560, you're most likely going to head down into this 555 level as the buying pressure would die off, and then you would come down. You could call it a gap fill if you want, for those that love gaps and gaps get filled. Could be a gap fill, but essentially you can see that you're just kind of stuck in this pre-market price action. So you're waiting to see what's going to happen. Usually you want to wait for the first 15-minute candle. Right, if you guys watched the video, then you understand why. You're looking for a break of that low down into 560, break of 560, you get the gap fill, maybe down into 555, a break over the high, you get the gap fill, maybe up into the 570 level. Remember that we are in a buy the dip environment, so don't be surprised if this gets bought up. We'll just have to wait and see what happens once the pre-market price action is done and the volume actually comes in. So that's kind of the first thing I just wanted to go over. So nothing too crazy yet. Not expecting much here today or tomorrow. And then Wednesday, I think we'll probably get the same thing. I think Powell will say something along the lines of, I don't really care what Trump thinks. I'm going to continue to do what I do. Will the market like that? Will the market not like that? I don't know. We'll have to wait and see. Let's see. Somebody asked me a question. Hey, Andrew, what video are you referencing? The Market Maker video, right? If you guys haven't watched the Market Maker video, you go into pinned messages. Go into this one right here. You click this. It's going to take you into these two videos that I have pinned. This one right here. It talks about how they use the opening 15 minutes to push people into positions. So if you guys haven't watched this on Confessions of a Market Maker, highly recommend you watch it. If you're day trading, you haven't watched this, then you probably don't understand why a lot of things happen. If you haven't watched this, this is why your broker is not your friend, right? So your broker is not there to help you. They're actually there to take advantage of you. So again, make sure you watch them. Some people call it the opening range breakout, right? The orb strategy. There's lots of different things. That's just kind of the why behind the orb strategy. So again, first 15 minutes usually is a lot of manipulation as market makers just continue to fuck with people as they get things ready to go. So nothing too crazy there. Don't get all excited. Don't be like, oh my gosh, I'm going to catch this huge move at the start of the day. Like, it's just not smart. So, okay, if you want to scalp it, scalp it. But in reality, we're most likely not going to get much. We'll have to wait and see. With that being said, then we go into just some of the things, right? If you go into swing trades, they've been pretty successful. We just had Tesla alerted last week on the 1st. Those are up 40% at their high. So not bad there. If we go look at Tesla, we're waiting to see if it's going to break out. Again, we talked about this last night. We said if the market is a little bearish, there's a good chance Tesla could pull back. That's what you're seeing right now. So Tesla needs to break these highs out of this box. This order block here about 305. Then you're looking at upside into, possibly 360 up into this area, like 350 to 360-ish, right? So a lot of room here to the upside if Tesla can break out of this area. Hasn't been able to yet. So we'll just have to be patient. But if it does happen, could be a nice move. We also have the 337 here for May, right? That's the May target. So not too bad there. And again, you can go through and look at the performance. Google had a great move at 100%, gold 85%, Apple 165%. So nice move there. Tesla's the only open one right now. Essentially, everything else has pretty much made their moves for the most part. The other thing that I did is I went through over the weekend and I wrote down all the targets for all of the long-term alerts. These are not options. This is equity. So you can see. And also I'm going to go through and I'm going to delete anything that is already hit. So I already went through and deleted a bunch of them. So any report that has already been hit will be deleted out of this channel. So we can only keep active reports, as well as I'll update this price target list. And once they're hit, I will take them off this list as well. So if you guys are following along to this, you're using it for equity positions, just understand, that's some of the things that I'm changing and I'm going to do. And then recently I talked about it. I'm going to start a little test. Again, tests are what tests are, right? So there are no emotions to them. It is strictly follow these parameters and then measure the results, right? That's how you measure something, to build confidence within the strategy, to understand it. So I'm going to use this channel to run a small test. Essentially, I did the math over the weekend since February 20th, which was the start of the bear market. If following the test, the portfolio would be up 46%. So we're going to test it. There's going to be some parameters. One, I'm going to use leverage, equity. You can use options if you want. Some people have already asked me. I'm going to use leveraged equity. I'm going to use SPXL on the long side. I'm going to use SPXS on the short side. I'm going to use two triggers.
So 4-hour QQE, which is what gets alerted in here, and trend indicator, which you can find in the pinned messages. Those will be the two triggers for an entry point. Profit targets are as such 5, 10, 15%. Will scale out at those points. And then the other thing is you're only going to get maybe 1 entry point to 2 entry points a month. So don't jump into this test thinking you're going to be day trading this. You are 100% not going to be day trading this. If you think you're day trading this, don't do the test. Like, I don't want to answer questions about this every single day. This is not a day trade. This is obviously a swing trade. And you're only going to get opportunities to enter positions when they provide themselves as such. So, as you can see, if you're looking at something like this and you're saying, hey, I'm only going to get in when this sets up, right? This is short. This is short. I'd go short. This is long. I wouldn't enter this long. I could enter this short again because I'm still short on the trend. Therefore, I entered on the 26th and I entered again on the 4th. So, a good amount of time, a week and a half of time passes where I get 2 trades. This is not a trade. So you're not going to be entering things and exiting things on a daily basis. That's not what this test is about. This test is to measure, if I disconnect emotions from this and I strictly follow this strategy, what is the success rate, right? So those are a few things over the weekend that I played with and worked on to streamline things and make things easier. So orb is opening range breakout. It's nothing special. Opening range breakout. So that's it. That's all I have. Covered everything else last night. So I'll answer some questions and then we'll go from there.